Hello and welcome to the Financial Power Hour. My name is Greg Hammond, CEO of Hammond Iles Wealth Advisors. And on behalf of our entire team, I'd like to welcome you here to our monthly Financial Power Hour. And today we're going to talk about everything you want to know about retirement accounts, because retirement accounts play an important role to your financial future. We want to make sure that you're aware of all of the opportunities available to you, as well as the rules that may impact you later in life or in retirement. So today, we're going to talk about everything you want to know about retirement accounts. Now, when it comes to retirement accounts, there are two basic types of retirement accounts. The first is what we call employer or company plans. And a number of them are based on sections of the tax code, and that's why they have names like 401k, 403b, or a 457 plan. If you work for the federal government or in the military, you may have the ability to contribute to the Thrift Savings Plan or TSP. And if you have your own business, you may be able to contribute to a solo 401k or a SEP IRA. Or if you have a small business, maybe a simple IRA. So all of these different types of plans are what we call an employer or company plan. So when I'm talking about employer plans, it typically applies to all of these types of plans unless I specifically mention an exception otherwise. So when we talk about employer company basics, what we find is that traditional contributions go into the account before taxes, and it's usually through deductions from your paycheck. So when you get that paycheck, you'll see the deduction for your 401k, and it comes out before the payroll taxes are even calculated. It's before taxes. Now, the account itself will grow what we call tax deferred, meaning that the capital gains that are earned in the account or dividends or interest, none of that is taxable to you on an annual basis. It just grows and grows and grows until which point in time you decide to take a distribution out of the account. And because the money went in before tax, those original contributions plus all of that growth and appreciation all comes out as taxable as ordinary income in the year that those funds are distributed out to you. So that is one of the benefits, is you get to control as to how much that is taxable by how much you take out each year, although there will be a period of time that you have to take out a minimum distribution, and we'll talk a little bit about that a little bit later. Now, if you're contributing to a traditional employer plan for 2022, the elective deferral limit per employee is $20,500. Now, if you're over age 50 or age 50 this year, you have the ability to contribute an additional what we call a catch-up contribution of $6,500. So if you're 50 or older, you can contribute up to $27,000 into your employer plan. So when we're talking about employer company plans, then what are some of the tips or things that you should be aware of to take full advantage of those plans for your financial future? Well, one is you want to make sure that you contribute enough of your salary to capture the full amount of your employer match. Many employers offer a match to their retirement plans to provide a benefit to you, as well as an incentive to get you to stick around. Especially nowadays, that is a challenge with many job opportunities and people leaving their offices of employment. They want to encourage you to stay. And so they may, for example, match up to 4% of your salary. So if you are contributing 4% of your salary, you're immediately going to get 100% of that matched. So you're doubling your money without getting any growth or interest or dividends or anything earned on that contribution when it goes in. So why not take advantage of that free money and make sure that you're contributing at least as much as your employer is willing to match? Now, some employers may not match dollar for dollar 100%. They may, for example, contribute 50% up to 6% or whatever percentages. But you want to make sure that you can contribute up to that full amount, even if it's 50% on 6%. Contribute your 6% and make sure that you're getting that full 50% match. That's an easy 50% increase on your contribution. So make sure that you're maxing that out to get your full company match. Now, the second thing is to consider when you are contributing to an employer retirement plan, is that when you get a raise, consider taking a portion of that and adding it to your retirement account. So for example, if I am contributing 4% to my employer retirement account, and my employer gives me a 3% raise, and I'm comfortable living on my salary as it was before my raise, why not take 1 or 2% of that 3% and add it to the 4% I was already contributing? So I can bump that up to 5 or 6% of my new higher salary and still take 1 or 2% of an increase home in my paycheck. So I'm putting money away for my financial future while still giving myself a little bit more money in my pocket. It's a great way to compound what you are contributing to a retirement account for your future. And the earlier that you can get money into that retirement account, the better you will be over the long run. Now, a couple other features that you may want to look into is you may have the opportunity to contribute to a Roth version of your 401k. And if so, you can do so on an after-tax basis. That money then grows tax deferred and eventually comes out tax-free. Now, because it's paid after taxes, if you want to make sure that you don't need the tax deduction, that you can afford to pay the tax on it before contributing to the Roth 401k. But if you can, it's a great way to build money on a tax-free basis. And I'll talk a little bit more about Roth when I talk about the Roth IRA in just a little bit. Now, another thing to consider that could be a potential benefit to your employer or company plan is what we call an in-service rollover. It's when you're still working for the company where they allow you to roll part of your retirement account out to an individual retirement account that may have better investment options for you. It may allow you to work with a professional investment advisor, a financial coach like Hammond Iles. It may have a variety of different benefits that may be beneficial to you. But if that is something that is available to you, I encourage you to reach out to a financial coach and just ask the question if it may be in your best interest. And one of the ways that you can do that is go to hiwealth.com, and you'll see in the top right corner of our website a button to click on for your free complimentary 15-minute conversation with a financial coach. We'd be happy to look at what options are available to you with your employer retirement plan and make some recommendations to you. Now, the second type of retirement account besides an employer company plan is what we call an individual retirement account. And that has two different types, what we call a traditional IRA or a Roth IRA. Now, a traditional IRA, similar to a traditional employer plan, allows you to put money away before tax. And the amount that you can contribute each year is capped at $6,000 per year if you're under the age of 50, or you get that extra $1,000 catch-up contribution at age 50 or older. So there is an advantage of getting a little bit older. Now, those contributions must come from earned income. So that's reported to you on a W-2 or a 1099. That does not include your Social Security or pension income. It has to be earned income. But also you have the ability to count the earned income of your spouse. So if your spouse has earned income, you can use that to contribute to your own IRA or contribute to your spouse's IRA. So for example, if you're under the age of 50 and you have an earned income of more than $12,000, you could contribute up to $6,000 for your IRA and up to $6,000 to your spouse's IRA. Now, contributions do have some limitations based on your modified adjusted gross income or whether you are eligible for an employer retirement plan. So for 2022, if you are eligible with an employer plan, if you're single, your ability to make that $6,000 contribution if you're under age 50 starts to phase out between $68,000 and $78,000. So in between, you get a portion of it, but after $78,000, you are ineligible to contribute to a traditional IRA. For joint taxpayers that file their taxes jointly, that phase out range is between $109,000 and $129,000. And again, that is if one or both spouses are eligible for an employer retirement plan. Now, if you're an individual or a couple that are not eligible for an employer retirement plan, those phase outs are different. If you're single, there is no income phase out. So no matter your income, if you're not eligible for an employer or company plan, you can contribute to a traditional IRA. And for a married couple filing jointly, that phase out range is higher without an employer retirement plan of $204,000 to $214,000. And again, if you didn't get a chance to write those down, go to our website at hiwealth.com and just click on the button for a complimentary call or reach out to our office at hello@hiwealth.com and we'll be happy to provide those phase out ranges to you. Now, just like a traditional employer plan, the account grows tax deferred until the funds are distributed out to you out of the account. And when that happens, those distributions are taxable to you as ordinary income in the year that you take those out. So you have control over how much and when that becomes taxable income to you. So that is one benefit of keeping track of that. And when you do reach age 72, you will be required to take out a minimum distribution. Uncle Sam gets tired of waiting. And so at 72, he says that you have to take out a minimum percentage. And the way that that's calculated is the end of the prior year balance divided by a life expectancy figure, which is taken off an IRS table. For at age 72, there's a new table in 2022 that your life expectancy is 27.4 years. So it's roughly 3.6% that will be required to be taken out in that first year. Now, each year that divisor becomes less, your life expectancy gets shorter, and hopefully your IRA is growing, so the top number gets larger, and so your minimum distribution will get larger over time. Now, there are some ways that you can avoid paying tax on that RMD, and I'll talk about that as some strategies in just a little bit. Now, your Roth IRA, just as I started to tell you a little bit at the Roth 401k contribution, is an after-tax contribution in that the money goes into the Roth IRA after taxes. You don't get a tax deduction, but you get the advantage of it continuing to grow tax deferred. And once again, those contribution levels are $6,000 if you're age 50 or younger. I'm sorry, if you're younger than age 50. And if you're age 50 and older, you get that $1,000 contribution, which is $1,000, so you can contribute up to $7,000. Now, one thing I'd like to point out is if you're eligible to contribute to an IRA, you can't contribute $7,000 to a traditional IRA and $7,000 to your Roth IRA. You can't double dip. It's $7,000 total per calendar year. So you could put $4,000 into a Roth IRA and $3,000 into a traditional IRA, but you can't between the two contribute more than whatever you're eligible to contribute. So you want to make sure that you take that into consideration. Now, again, for a Roth IRA, contributions must be from earned income. So It comes from a W-2, 1099. It doesn't count as your Social Security or pension. Those are not earned income. And again, it can be from a spouse. So if your spouse has earned income, that can qualify to be eligible for a contribution to your Roth IRA. Now for 2022, again, there are income phase outs. So for individual single filers, that phase out range is between 129,000 and 144,000. And for married couples filing jointly, that's 204,000, 214,000. Now, keep in mind that for Roth IRAs, there's no delineation between whether you're eligible for an employer company plan or not. There's just these income phase outs no matter what. Now, just like a traditional IRA, the account grows tax deferred until the money comes out to you. So all the growth and dividends and interest, you don't pay tax on it on an annual basis. However, and here's where the Roth IRA really has the benefit, is that if you've had the Roth IRA for 5 years and you're over the age of 59 and a half, all of the distributions, that's everything you contributed to it, plus all of the growth of your Roth IRA will come out to you tax-free. No taxes, no income taxes, federal or state. And because of that, there are no required minimum distributions. So Uncle Sam doesn't care when you take it out of the Roth IRA because there's no tax consequences, so they don't care. Now, if you've heard me talk about retirement accounts before, whether it's on our podcast, Your Money, Your Purpose, which you can also find on our website at hiwealth.com or any podcast platform that you listen to, one of the things I talk about time and time again is everybody, I mean everyone, should have or needs a Roth IRA. And there are several reasons why I say that. One is that the contributions into a Roth IRA can be distributed tax-free without a penalty at any age, at any time. Now, the investment growth and earnings need to stay in the Roth IRA for that 5 years and until you reach age 59 and a half to avoid taxation and any potential early withdrawal penalty. But your contributions can come out at any time. So if you're 25 years old and you're thinking about putting money into your Roth IRA, you don't have to be concerned that that $6,000 or $500 a month that you're putting into the plan, that you're going to have to leave it there forever if you have an emergency. If you have a dire emergency and you need to tap into that retirement plan at last resort, you have the ability to take those contributions back out without any taxes or penalties. So it's a great way for everyone of any age to save for retirement. Now, also for those that are approaching retirement, or even if you're young and thinking about retirement in the future, the benefit is it also provides diversification for income tax planning. So if I have my 401k, which I'm contributing to on a pre-tax basis, which I know all of the money coming out of it will be taxable income to me in the year that I take it out. And I also build up my Roth IRA, which I know will come out to me tax-free. Then I have a combination. So if I happen to have an income that's close to a tax bracket, I could take a little bit more from the Roth IRA, tax-free, and keep my taxable income below that bracket that I want to stay under. Or for some reason, if I get a bonus and I have a higher income in that year, I can take more income out of a Roth IRA later in life if I'm still working at that time. So it gives you the flexibility to plan your retirement income as to what you want it to be on being able to take some money from a tax-free account versus a taxable account. Now, certainly if you're young and you have the ability, if you put it into your Roth IRA and a Roth 401k and it all is tax-free on the end, that's the best scenario because it'll all come out tax-free to you in retirement. But otherwise, it's great to have a Roth IRA to diversify your ability to take income in retirement. Now, if you are getting later in life or just are looking at the fact that you don't have much in a Roth IRA, whether you are over the income limits and ineligible to contribute to a Roth IRA, one way you can get money into a Roth IRA is through a conversion. If you have a traditional IRA, you can actually convert a portion or all of that IRA from the traditional into the Roth IRA. Now, please keep in mind that the time that you do that, it becomes taxable income to you in the year that you convert it over to the Roth IRA. But then from that point forward, it'll grow in the Roth IRA and come out all tax-free. So it's a great way to build that up if you don't have a lot in a Roth IRA already. Please keep in mind, one of the rules of thumb, though, that I always talk about is that don't convert anything from a traditional IRA to a Roth IRA if you need to tap into that IRA to cover the tax consequences. So you'll only want to convert what you can afford to pay the tax on to convert that traditional to a Roth IRA. Now, one little side note or strategy is if you have money built up in your savings account and you're earning a very low interest rate on savings, you may want to look at using some of that to pay the tax on converting your IRA from a traditional to a Roth or a portion of it. So again, if you'd like some consultation or a free conversation around that, give our office a call at 800-416-1655 or go to our website at hiwealth.com and click on the button for a free complimentary consultation. Now, one of the things that is nice also about the Roth IRA is that you can contribute to a Roth IRA at any age, including if you crossed over age 70 and a half, 72, you and your spouse, as long as you have earned income and are eligible to make the contribution because of your income level, you can contribute at any age. And this goes for the other end of the spectrum as well. I just want to say this is a great way for you to incentivize your children and grandchildren to save for their retirement. It's a great way to introduce them to investing for their financial future. What I did for my own daughters is I matched their donation or contribution to their own Roth IRA once they're old enough to work and have earned income. So when they have that earned income on a paycheck towards the end of the year, I'd be like, well, how much do you want to put into your Roth IRA? And I will match it. If you put in $200, I'll match it $200. And so that incentivized them to take some of that earned income from their summer job or the job that they have after school to put some of that away for retirement. So consider doing that for your children or grandchildren. Just keep in mind, they have to have earned income. So if your grandchild is young enough that they don't have earned income yet, you can't make a contribution on their part. Now you can contribute even if they don't contribute to it themselves. As long as they have earned income, you can make a contribution on their behalf up to what they earned that year. Now, when we're talking about ages, there are 4 important ages that you just need to be aware of as you get a little bit older. Some of us are getting there. You may already be there. No matter where you are, we're glad you're here today to learn about the important things that you need to know about your retirement accounts. And the first important age that you need to know is age 55. Because if you're getting close to potentially retiring early, let's say that you have been a diligent saver early on and you're looking to retire early, you may want to pay attention if you're getting close to age 55. Because at age 55, if you retire from a company and you have an employer company plan, you are able to take distributions out of that plan after the age of 55, but before the 59 and a half requirement, without any 10% early withdrawal penalty. Typically, most people with retirement accounts, 59 and a half, which we'll get to in just a minute, is the minimum age that you need to have to take money out without a 10% early withdrawal penalty. But company plans have this special age of 55 that you're able to take distributions without the early withdrawal penalty. But to qualify, you must retire or leave your company at or older than 55. So if you're approaching, you want to make sure that you stick around, have that last birthday party at your company, and then retire so that you're eligible for this option. Now, the next age, as I mentioned, is 59.5. Now, why this is important is that is the age at which you can start taking distributions from your retirement accounts, whether that's an employer retirement plan or your traditional IRA, or without that 10% early withdrawal penalty. If you take money out of your IRA before 59.5, not only will it be taxed as ordinary income, but you'll also pay a 10% early withdrawal penalty. Now, there's no requirement when you get to 59.5 that you have to take anything out. It's just a threshold that you cross over that you're now eligible to take it out without any penalty. And you can take as much or as little as you want out after that point. And as I mentioned, all distributions will be taxed as ordinary income, except for after-tax contributions, like the Roth IRA, for example. Now, the next important age is 70.5. And this used to be really important because it was the age that required minimum distributions kicked in. But I'd like you to know that because of the Secure Act that was passed in 2019, that age has been bumped up, and we'll talk about that age next. So 70.5 does not apply to your required minimum distribution. You are eligible for a qualified charitable distribution, however, at 70.5. That has not changed. And what I mean by a qualified charitable distribution is that you're able to distribute money directly from an IRA to a charity. It will count towards your minimum distribution if you're of that age, or not of that age, as long as you're 70.5. It'll come out of your IRA without any tax consequences. It's not reported as income to you. And you can contribute or distribute up to $100,000 per year out of your IRA. So if you're charitable minded and have an organization or cause that you care about, and you're over the age of 70.5, this is a great way to do your charitable giving and pay with before tax dollars. Rather than writing a check with your after-tax savings, consider making a gift out of your IRA to your favorite charitable organization. It's a great way to, again, save income taxes for you and make an impact on an organization that you care about. Again, if you have any questions about QCDs or qualified charitable distributions, go to our website at hiwealth.com and click on a free complimentary consultation. Now, the last important age that I want you to be aware of is age 72. Now, 72, with the passing of the Secure Act, is now the age that you must start to take a required minimum distribution. And again, it's the balance of your IRA divided by a life expectancy number that comes up with that minimum distribution. And except for your first year, it has to come out during each calendar year. The special exception there is that your first year, it has to come out in the year you turn 72 up until April 1st of the year following the year that you turn 72. So you could actually take it out up till April 1st of the year that you turn 73. Now, keep in mind, however, though, that if you wait and take your first distribution in that window between January 1st and April 1st, you'll have to take out two distributions that year, your first one and the one for being 73. So we recommend starting for, in most cases, in the year that you turn 72. Now, there may be circumstances where it makes sense to defer it. If you have a spike in income or retiring and you're getting a bonus on the way out, you may want to defer it until the year that you turn 73, for example. But you always want to be aware of that, because by not taking that minimum distribution out, it is the stiffest penalty in the entire tax code. You would get penalized 50%. That's half, 50%. And that is on top of the income tax that you would pay on it. So if you were required to take $1,000 out of your IRA for a minimum distribution and you didn't take it out, you would not only pay income tax on the $1,000, but you would pay a penalty of 50% or $500 on top of that. You could lose almost all of your distribution if you don't take it out. So it's very, very important that if you're age 72, approaching 72, or over 72, that you make sure that you're working with a financial coach who makes sure that you take out your minimum distribution each year. Now, there is one exception. If you're still working, your RMD for your company plan can be deferred as long as you're still working. So if you're going to work, for example, till age 75, you can defer your minimum distributions from your company plans until you retire. Now, once you retire out of your company, then those minimum distributions kick in at that point. Now, also, as you take those distributions out, there's nothing that says that you have to spend it all. You can turn around and reinvest it. It just means that you have to reinvest it in a non-retirement account outside of your retirement accounts. So keep that in mind. Age 72 is the year that you turn of age that Uncle Sam gets tired of waiting. They want you to take out that minimum distribution. Now, when we talk up to a number of people, one of the things in changing jobs throughout your career is that you may have an old employer retirement account. So the question is, well, what do I do with it? Well, there are 4 options, and we'd like to just take a few minutes to go over what those are. The first option is that you can leave it there. Most company plans, if you at least exceed the minimum investment amount, many plans is $5,000 or $10,000. If you have a balance higher than that, they'll let you keep it there. Now, there's no charge for that. You maintain the same investment options. But 3 reasons why you may want to consider doing that is that there may be an attractive investment option in your 401k or a company plan that you can't get outside of it. For example, a stable value fund, which is a bond fund with an insurance wrapper that pays a good interest rate and has no fluctuation in value. Also, employer retirement accounts allow you to take loans. So if you need a bridge loan between houses, or you just need some cash for an emergency expense, you can actually tap into your employer account, take a loan, and pay yourself back. Now, once you move that account out to an IRA, that goes away. So that may be an option why you may want to keep it in a 401k. Now, the third reason is that you might meet one of those age exceptions. So if you're over the age of 55 or planning to retire after age 55, you may want to leave it in your employer retirement account. So those are some reasons why you may want to leave it in. Now, 4 reasons why you may not want to leave it in is you do have limited investment options. So whatever your employer chooses as the investment options for your employer plan, that's what you have. Also, once you leave that employer, you have no way of adding to that account. So it's just an orphan account sitting there. You can keep it there, but you're not going to be able to add to it. It's just there. Now, other types of investments are available to you outside of that plan. Whether you choose to roll your old retirement plan out to a new employer plan or out to an IRA, it opens up different investment options for you. Also, that charitable option of a qualified charitable distribution is only available out of IRA accounts. So if that is something of interest to you, you can't do it from an employer plan. So you'd have to roll that money out to an IRA to be able to make a qualified charitable distribution. Now, the second set of options is to take the money out of the plan. And there are 3 places that you can take it. One is you can just take it outright as a distribution. The funds will be free and available to you to use as you want. However, that distribution, when it comes out, will trigger all the taxation on it and could potentially be subject to income tax and penalties depending on your age at the time that you do that. And it wipes out what you've already socked away for retirement savings, and you lose that tax deferred growth. So we do not recommend option 2A here, but certainly please contact us if you would like to talk about your options. Now, option 2B is that you could transfer to a new employer retirement account. You leave employer A and you go to employer B. You can move it from one 401k to the next 401k. It maintains the tax deferral. There's no tax consequences on the transfer between plans. And it allows you to consolidate your accounts at your new employer. Now, that plan, just like your old plan, will be subject to a new list of investment options that are available to you inside that new employer plan, but it allows you to at least kind of keep everything in one place if that is of interest to you. Now, the last option, or the fourth option, option 2C, is to roll over the account to an individual retirement account. Now, just like taking it to an employer company plan, it will maintain the tax deferral as long as it goes directly what we call trustee to trustee transfer, or if you take that money out, you roll it over within a 60-day window. Ideally, you don't want to risk it in that 60-day window, so we typically always recommend a trustee to trustee transfer if this is of interest to you. Wow, tongue-tied. So if that is of interest to you, you can transfer it trustee to trustee without any tax consequences. Now, the other thing is that it will be subject to new IRA rules. So if you roll your 401k out to your IRA at age 57, now you're subject to the 59.5 minimum age requirement for an IRA versus the employer plan that may have applied to 55 if you retired after 55. Now, one of the benefits of an IRA is that you can make additional contributions if you're eligible. You have complete control over the investment options and whether you want to work with a financial professional or not to run and manage that account. And you can make those qualified charitable distributions. Again, that's distributions out of your retirement plan to a charity that's not taxable to you when it comes out. Now, here are three things that are commonly overlooked with retirement accounts. One is that you're applying an exception to the wrong type of retirement account. We'll talk a little bit about those. Also, one of the strategies for employer retirement plans is called net unrealized appreciation. So if you own stock inside a company plan, you'll want to pay attention to this example that we'll go over. Or you also, no matter the type of retirement account you have, you always want to pay attention to beneficiary designations. And we'll talk a little bit about that in just a minute. So here are some exceptions to that 10% early distribution penalty if you take money out before age 59.5. Now, isn't that sweet of Uncle Sam that if you die, they will allow you to take money out of your retirement account without the 10% early withdrawal penalty? Isn't that nice of them? Now, I wouldn't recommend that as a way to avoid the 10% early withdrawal penalty, but it is one of those exceptions. Now, another exception is if you become disabled, you're able to access your retirement accounts. They don't penalize you for that. You can also set up what are called 72T distributions, or substantially equal periodic payments, where if you're under the age of 59.5 and you need to tap into a retirement account, you can actually set up payments to yourself that will avoid the 10% early distribution, but there's a calculation method as to how those payments are calculated. And once those start, you have to take them out at least until age 59.5, or at least for 5 years, whichever is longer. So we only want to turn that on as a last resort. Now, also, if you have the circumstances where you need to tap your retirement funds for medical expenses, you can tap into it without the 10% early withdrawal penalty. Also, isn't it nice that if you owe money to the IRS, they'll allow you to take your money out to pay the IRS. So they will waive their early distribution fees for distributions to pay off your levy from the IRS. And if you're an active reservist, thank you for your service, but you're also able to avoid the 10% early withdrawal penalty. Now, There are some exceptions just for IRAs. These do not apply to your employer plan. So this may also be a reason to roll over an employer plan account over to an IRA. You can tap in for higher education expenses, first-time home buyers, or for health insurance if you're unemployed to cover the premiums. There are some limitations on these. So again, if these are interest to you, please call and talk to a financial coach at Hammond Iles Wealth Advisors to make sure that you're not getting yourself in hot water and compounding your problem by tapping your retirement account. Now, one of the things for the company plans that does not apply to an IRA are a few different things. One is age 55. Again, you retire after 55, no early withdrawal penalty. And that's actually lower for public safety employees. So that is age 50. So we could have added a fifth age there. Age 50 for public safety employees is to be aware of. 457 plans, if you work for a municipality, most 457 plans do not have an early withdrawal penalty. So it may be a reason to keep that money in and tap into that first. Also, if you have gone through a divorce, if you're subject to a qualified domestic relations order, or what we call a quadro, you're able to tap into your employer plan of your spouse if you get part of their account without the early withdrawal penalty. And for those that are under the age of 59 and a half, this may be a very important reason to keep it at the employer rather than rolling it over to an IRA. So all of those things you want to talk about with your accountant as well as your financial coach to make sure that those exceptions don't apply to you. And if so, are you using the right account to take advantage of them? Now, the second thing that I pointed out that you want to be aware of for your retirement plans is what we call net unrealized appreciation. Now, this is a tax saving opportunity where if you have a large portion of your employer retirement plan that's invested in company stock and it's appreciated in value, there may be an opportunity to save some money on that distribution. And the way that it works is you take a lump sum distribution of your entire employer retirement plan, except the stock gets set aside into a brokerage account, and the pre-tax or after-tax portion goes to an IRA or a Roth IRA to maintain the tax deferral, but you get some benefits on that stock. And that your company stock, you only pay income tax on the original cost basis. And I'll go through an example here, but if you have $100,000 worth of stock and you only paid $10,000 for it, you're only going to pay tax on the $10,000, not the $100,000 when it comes out. The advantage there is that at least at the present time, capital gains taxes are less in tax than ordinary income taxes. So it can be a way of saving tax because you only pay them the capital gains tax on that tax appreciation, tax deferred appreciation on the stock when you sell it. And you can control when it is sold. So it's treated as long-term capital gains, not ordinary income. So let's take a look at an example. So you purchased 100 shares of stock inside your employer plan at $10 per share. So you basically paid $1,000 for it. And that stock has gone up to $100. So now it's worth $10,000. So that appreciation is what we call the net unrealized appreciation. It's the difference between the $10 and the $100, or the $90 difference. Where if you cash in the stock and you took it all out of your retirement account, you'd pay tax on the full $100. Whereas if you pull it out as just the stock, you're only going to pay tax on the $10 per share of the $1,000 that you invested. So here's what that looks like tax-wise. So on 100 shares, if it's now worth $10,000, you sell it and take it out, assuming that between federal and state taxes, you have tax rate of around 30%, you would pay $3,000 in taxes. Now, you don't have any capital gains because you took the money out as a distribution from the retirement plan. So you would just have the $3,000 of ordinary income tax. Now, let's take a look if we take that same $10,000 as stock and we transfer it out of the retirement plan with a transfer to a brokerage account. what we find is that $10 per share or the $1,000 cost basis is what you would pay tax on. So again, 30% of that, you'd pay tax of $300. Now, the $9,000 of net unrealized appreciation is taxed as your capital gains rate. Now, in this example, the rate is 15%. And for most individuals, that's probably accurate. If you have a higher income, you may be as high as 20%. Or if you have a lower income, it may be actually 0. If that's the case, then it would be a no-brainer to use a net unrealized appreciation. So you always want to take a look at that and consult with your tax advisor on what might make sense for you. But in this example, that $9,000 is taxed only at 15% or $1,350. So the total tax consequences is only $1,650. That's a whopping 45% savings. Now, this is just $10,000. If you added that, put some zeros on the end of it, it could be a substantial dollar amount in savings. So if you own company stock in your employer retirement plan, you owe it to yourself to ask the question, should I consider a net unrealized appreciation strategy when I retire? So that's definitely something you want to look at. Now, the other important thing with retirement accounts is your beneficiaries. Because even though you may have the best will, the best trust that money can buy to create your airtight estate plan, it is the beneficiary designation form that's going to direct where your retirement accounts go, not your estate planning documents. So if you want to make sure something happens, you want to make sure that those beneficiary designations are up to date. Because major life events happen. You get married, you get divorced, you have a birth of a child or a death of a loved one. You want to make sure that that is all updated to reflect those changes in your life. Unfortunately, I have seen it where a divorced couple never updated their beneficiaries. And even though they may have remarried, when they passed away, their retirement account went to their ex-spouse because they never updated the change of beneficiary form. Now, also, you want to be aware of tax consequences and the impact that it can have on your beneficiaries. Now, naming your estate as a beneficiary may trigger a tremendous amount of estate tax. So it basically, to get to your estate, it all has to be taxed on the way out. So it's important to look at your beneficiary designations in your estate planning to make sure that you get it passing to the people you care about or the organizations you care about in the most tax efficient manner. Now, one important thing that changed in 2019 with the setting every community up for retirement enhancement, or the Secure Act, I think sometimes there's probably a whole department just trying to think up these catchy names. What acronym can we come up with for the next act that's going to be passed by Congress? So the Secure Act, it was passed into law in 2019, and it eliminated the stretch IRA strategy for non-spouse beneficiaries. So what exactly is the stretch IRA? Well, a stretch IRA is when a beneficiary would have the ability to stretch out that inherited retirement account over their lifetime. And they would only have to take out a minimum distribution each year. They could leave the rest of it in the account and let it grow. So if you had someone pass away in your family before January of 2020, you can still stretch your IRA. But after that date, if you're a non-spouse beneficiary, most likely that has changed for you. You have a new 10-year rule that you have to fully deplete the entire inherited IRA within 10 years of the original owner's death. Now, there are some exceptions to that rule. So you'll want to pay attention to that and have a conversation with a financial coach where that might apply. But for most non-spouse beneficiaries, you're going to have to deplete the account over 10 years. And there is no minimum distribution during that time frame. You have the flexibility. You could wait all the way till you're 10 and then take it all out, or you could take 1/10 out each year, or you could, if you're getting close to retirement, wait a period of years and then take it out after you retire when your income is lower. But there is some strategy and things that need to be paid attention to if you inherit a retirement account, or you're starting to think ahead of the people that you want to leave your retirement account to. And this, again, may be an instance when you want to consider a Roth IRA contribution, converting some of your taxable IRA or retirement account over to Roth so that your beneficiaries, when they have to take it out in that 10-year time frame, don't have to take out all out as taxable income. So I hope that our conversation today has started some questions for you. It may have spurred some things. Well, what about this or what about that for your retirement accounts? And we are here for you for any questions that you might have. Again, you can get your questions answered by going to our website at hiwealth.com, and you can click on the button to schedule a free complimentary consultation to schedule a time to answer your questions with a financial coach at Hammond Iles Wealth Advisors. So this wraps up our Financial Power Hour today. Thank you for taking time and spending it with me. You'll hopefully have found this information valuable, and we look forward to seeing you on our next Power Hour or educational event. Take care, be well, and save for that financial future so that you can live a life of freedom and fulfillment. Because at Hammond Iles Wealth Advisors, we are here to make a meaningful difference in your life.